Section 3.1 to 3.3 Maximizing Capital Gains. 3.1 Investment Strategies for Capital Gains. Growth investing is an investment strategy that focuses on identifying assets that have the potential for significant price appreciation in the future. These assets are typically associated with companies or sectors that are expected to experience above-average growth rates compared to the broader market. Here are some key considerations for identifying assets with growth potential. Company fundamentals. Assess the company's financial health, including its revenue growth, earnings growth, and profitability. Look for companies that have a strong track record of consistent growth and demonstrate the potential to sustain that growth in the future. Pay attention to factors such as market share, competitive advantages, and innovative products or services that can drive future growth. Industry and sector trends. Identify industries or sectors that are expected to experience significant growth in the coming years. Look for sectors with favorable long-term trends, such as technology, healthcare, renewable energy, or emerging markets. Understanding the underlying drivers of growth in these sectors can help identify assets that may benefit from those trends. Disruptive technologies. Consider investments in companies that are at the forefront of disruptive technologies or innovative business models. These companies have the potential to reshape industries and capture substantial market share, leading to significant price appreciation. Examples of disruptive technologies include artificial intelligence, blockchain, cloud computing, and clean energy. Market size and addressable market. Evaluate the size of the market the company operates in and its potential for growth. Companies that address large and expanding markets have a higher chance of achieving substantial growth. Look for companies that have the ability to penetrate new markets or expand their market share within existing markets. Management team. Assess the quality and track record of the company's management team. Strong leadership with a clear vision and effective execution strategies can significantly impact a company's growth prospects. Look for management teams that have a history of successfully navigating challenges and delivering on their growth plans. Research and analysis. Conduct thorough research and analysis to identify assets with growth potential. This can include studying financial statements, reading company reports, analyzing industry trends, and monitoring analyst recommendations. Utilize various sources of information, including financial news, industry publications, and reputable investment research platforms. It's important to note that growth investing comes with inherent risks, as the potential for significant price appreciation is often accompanied by higher volatility and uncertainty. Diversification and a long-term investment horizon are crucial to manage these risks. Consider consulting with a financial advisor or investment professional who can provide guidance tailored to your investment objectives and risk tolerance. Value investing is an investment strategy that focuses on finding undervalued assets with the potential for capital gains. The goal is to identify assets that are trading below their intrinsic value, providing an opportunity for price appreciation as the market recognizes their true worth. Here are some key considerations for finding undervalued assets. Fundamental analysis. Conduct in-depth fundamental analysis of the asset, such as stocks or bonds, to assess its intrinsic value. Evaluate financial statements, earnings, cash flow, and other relevant metrics to understand the financial health and potential of the asset. Look for assets that have solid fundamentals but are trading at a lower price than their intrinsic value suggests. Valuation ratios. Use valuation ratios, such as price-to-earnings, P/E ratio, price-to-book, P/B ratio, or price-to-sales, P/S ratio, to compare the asset's current price to its underlying financial metrics. A lower valuation ratio relative to its peers or historical averages may indicate that the asset is undervalued. Margin of safety. Seek assets with a margin of safety, which means the purchase price is significantly below the estimated intrinsic value. This provides a buffer against potential risks or miscalculations in the valuation process. Contrarian approach. Consider assets that are out of favor or facing temporary setbacks. Market sentiment and short-term fluctuations can sometimes create opportunities to invest in assets that are undervalued due to negative sentiment or temporary challenges. Assess whether the negative factors are temporary or fixable, and if the long-term prospects of the asset remain intact. Balance sheet strength. Evaluate the asset's balance sheet strength, including its debt levels, liquidity, and overall financial stability. A strong balance sheet can provide a cushion during challenging times and increase the likelihood of the asset's recovery and potential for capital gains. Market inefficiencies. Look for assets in markets that are less efficient or where there may be less information available to market participants. These markets can sometimes present opportunities for finding undervalued assets that have been overlooked or misunderstood by the broader market. Patience and long-term outlook. Value investing often requires patience and a long-term perspective. The market may take time to recognize the true value of an asset, and short-term price fluctuations can occur. Be prepared to hold on to undervalued assets for a longer duration until their price reflects their intrinsic value. It's important to note that value investing comes with its own set of risks, including the possibility that the market may not recognize the true value of the asset in the expected timeframe or that the asset's value may not materialize as anticipated. Diversification and thorough research are essential to manage these risks effectively. Consider consulting with a financial advisor or investment professional who can provide guidance tailored to your investment objectives and risk tolerance. Sector rotation and thematic investing are investment strategies that aim to capitalize on market trends and sector-specific opportunities. Both strategies involve identifying sectors or themes that are expected to outperform the broader market and allocating investments accordingly. Here's an overview of sector rotation and thematic investing. Sector rotation. Sector rotation involves shifting investments across different sectors of the economy based on their relative performance and economic cycles. The strategy assumes that different sectors perform better at different stages of the economic cycle. For example, during an economic expansion, sectors like technology, consumer discretionary, and industrials may outperform, while during a recession, defensive sectors like consumer staples and utilities may be more resilient. Investors following sector rotation will adjust their portfolio allocations to take advantage of these sector-specific trends. Thematic investing. Thematic investing focuses on specific themes or trends that are expected to drive growth and create investment opportunities. These themes can be broad, such as renewable energy, cybersecurity, or e-commerce, or they can be more niche, such as robotics, healthcare innovation, or artificial intelligence. Thematic investors seek to identify companies that are well-positioned to benefit from these trends and allocate their investments accordingly. Thematic investing allows investors to align their portfolios with long-term structural changes and potentially capture above-average returns. Key considerations for sector rotation and thematic investing. Research and analysis. Thorough research and analysis are crucial for identifying sectors or themes that have strong growth prospects. Consider factors such as industry dynamics, technological advancements, regulatory changes, and consumer behavior to assess the potential for sector-specific or thematic outperformance. Diversification. While sector rotation and thematic investing may involve concentrated positions in specific sectors or themes, it's important to maintain a diversified portfolio. Diversification helps spread risk and reduces exposure to individual sector or theme-specific risks. Active monitoring. Both sector rotation and thematic investing require active monitoring of market trends, economic indicators, and relevant news. Regularly review and reassess your investments to ensure they align with the current market environment and sector-specific opportunities. Risk management. Understand the risks associated with sector rotation and thematic investing. These strategies can be more volatile and may underperform during periods of market turbulence or if sector-specific or thematic trends fail to materialize. Risk management techniques, such as position sizing, stop-loss orders, and regular portfolio rebalancing, can help manage risk exposure. Professional guidance. Consider consulting with a financial advisor or investment professional who specializes in sector rotation or thematic investing. They can provide insights, research, and guidance tailored to your investment goals and risk tolerance. It's important to note that sector rotation and thematic investing involve forecasting market trends, which can be challenging and subject to uncertainties. Additionally, past performance is not indicative of future results. Therefore, thorough research, diversification, and risk management are critical to successfully implement these strategies. 3.2 Tax-efficient investing. Managing capital gains taxes is an important aspect of investment planning. Here are two strategies that can help in managing capital gains taxes: tax loss harvesting. tax loss harvesting involves selling investments that have experienced a capital loss to offset capital gains realized elsewhere in your portfolio. By strategically realizing capital losses, you can reduce your overall capital gains tax liability. The losses can be used to offset capital gains, and if the losses exceed the gains, you can use the excess losses to offset up to a certain amount of ordinary income. It's important to be mindful of the wash sale rules, which prevent you from repurchasing the same or substantially identical investment within a short period of time before or after the sale. Tax loss harvesting can be an effective strategy to minimize capital gains taxes while still maintaining a well-diversified portfolio. Asset location. Asset location refers to the strategic placement of investments in different types of accounts to optimize tax efficiency. Different types of accounts, such as taxable brokerage accounts, tax-deferred retirement accounts, example, traditional IRA or 401k, and tax-exempt accounts, example, Roth IRA, have different tax implications. As a general guideline, investments with higher potential for capital gains, such as growth stocks or actively traded funds, can be held in tax-advantaged accounts, where the taxes on capital gains can be deferred or avoided altogether. On the other hand, investments that generate primarily interest income or qualified dividends, which are taxed at lower rates, may be more suitable for taxable brokerage accounts. By strategically allocating investments across different account types, you can potentially minimize the tax impact of capital gains. It's important to note that tax laws and regulations can be complex and may change over time. It's advisable to consult with a qualified tax professional or financial advisor who can provide personalized guidance based on your specific circumstances and the tax laws in your jurisdiction. They can help you evaluate your investment portfolio, assess tax implications, and develop strategies to optimize your tax efficiency while aligning with your investment goals and risk tolerance. Remember that while managing capital gains taxes is important, it shouldn't be the sole driver of investment decisions. It's crucial to consider your overall financial goals, investment objectives, and risk tolerance when implementing tax management strategies. Tax-advantaged accounts, such as individual retirement accounts, IRAs, and 401(k)s, offer opportunities to defer or minimize taxes on capital gains. Here's how these accounts can help. Traditional IRAs and 401(k)s. Contributions to traditional IRAs and 401(k)s are made with pre-tax dollars, meaning the contributions are deducted from your taxable income in the year they are made. This reduces your current tax liability. The investments within these accounts can grow tax-deferred, meaning you don't have to pay taxes on any capital gains or investment income generated within the account until you make withdrawals in retirement. By deferring taxes on capital gains, you can potentially allow your investments to grow more rapidly over time. Roth IRAs and Roth 401(k)s. Contributions to Roth IRAs and Roth 401(k)s are made with after-tax dollars, meaning you don't get an immediate tax deduction for contributions. However, qualified withdrawals from these accounts, including capital gains and investment income, are tax-free in retirement. By utilizing Roth accounts, you can potentially eliminate taxes on capital gains altogether. Tax-deferred growth. Both traditional IRAs/401(k)s and Roth IRAs/401(k)s offer the advantage of tax-deferred growth. By keeping your investments within these accounts, you can benefit from compounding returns without the drag of annual capital gains taxes. Over time, this can enhance your investment performance. Required minimum distributions. RMDs. Keep in mind that traditional IRAs and 401(k)s require you to start taking required minimum distributions, RMDs, after reaching a certain age, currently 72 years old in the United States. These distributions are subject to ordinary income tax rates and may include capital gains. However, Roth IRAs do not have RMDs during the original account owner's lifetime, which allows for potential continued tax-free growth. Contribution limits and eligibility. It's important to be aware of the contribution limits and eligibility requirements for each type of tax-advantaged account. These limits and requirements can vary depending on the specific account type and your income level. Consult with a tax professional or financial advisor to understand the rules and contribution limits that apply to your situation. Utilizing tax-advantaged accounts can be a powerful strategy to defer or minimize taxes on capital gains. However, it's essential to carefully consider your overall financial situation, investment goals, and retirement planning needs when deciding on the appropriate account type and contribution strategy. Additionally, tax laws and regulations may change, so it's always advisable to consult with a qualified tax professional or financial advisor who can provide personalized advice based on your specific circumstances. Timing investment sales strategically can help optimize your tax liability. Here are a few considerations to keep in mind when timing investment sales: long-term versus short-term capital gains. In many tax jurisdictions, long-term capital gains, assets held for more than 1 year, are taxed at lower rates compared to short-term capital gains, assets held for 1 year or less. By holding onto an investment for the required holding period to qualify for long-term capital gains treatment, you can potentially reduce the tax impact when you eventually sell the investment. Tax planning and marginal tax rate. Consider your overall tax planning and your marginal tax rate. If you expect your income to be higher in the current tax year compared to future years, it may make sense to delay the sale of investments with capital gains until a year when your income is expected to be lower. This can help you take advantage of lower tax brackets and potentially reduce the amount of tax owed on the capital gains. Capital loss utilization. If you have capital losses from other investments, you can strategically offset them against your capital gains. By selling investments with capital losses, you can use those losses to offset capital gains, reducing your overall tax liability. However, be aware of the wash sale rule, which prohibits you from claiming a loss if you repurchase the same or substantially identical investment within a short period of time before or after the sale. Market conditions and investment performance. Monitoring market conditions and the performance of your investments is essential when timing sales. If you believe an investment has reached its peak or is unlikely to continue appreciating, it may be advantageous to sell and lock in your gains. Conversely, if an investment has experienced losses and you anticipate a potential recovery, you may decide to hold on to it for a longer period to avoid realizing capital losses. Personal circumstances and financial goals. Consider your personal circumstances and financial goals when deciding to sell investments. Your short-term and long-term financial needs, liquidity requirements, and overall investment strategy should guide your decision-making process. Selling investments solely for tax purposes may not always align with your broader financial objectives. It's important to note that timing investment sales for tax optimization involves making predictions about future tax laws, market conditions, and individual circumstances. These factors can be unpredictable, and tax laws may change over time. Consult with a qualified tax professional or financial advisor who can provide personalized advice based on your specific situation and help you navigate the complexities of timing investment sales to optimize your tax liability. 3.3 Diversification and risk management. Diversification plays a crucial role in managing investment risk. It involves spreading your investments across different asset classes, sectors, regions, and individual securities to reduce the impact of any single investment on your overall portfolio. Here are some key points to understand about the role of diversification in managing investment risk. Risk reduction. Diversification helps mitigate the risk of significant losses by reducing the exposure to any one investment or asset class. When you diversify your portfolio, the performance of one poorly performing investment is offset by the performance of others that may be doing better. By spreading your investments, you can potentially reduce the overall volatility of your portfolio. Asset class diversification. Diversifying across different asset classes, such as stocks, bonds, cash equivalents, and alternative investments, allows you to balance risk and return. Different asset classes tend to perform differently under various market conditions. For example, stocks may offer higher growth potential but also higher volatility, while bonds may provide more stability and income. By diversifying across asset classes, you can potentially achieve a more balanced risk-return profile. Sector and industry diversification. Investing across different sectors and industries can help reduce the risk associated with the performance of specific sectors. Economic conditions and industry dynamics can impact sectors differently. By diversifying across sectors, you can avoid being overly exposed to the risks of a particular industry or sector, and instead benefit from the potential growth in multiple sectors. Geographic diversification. Geographic diversification involves investing in different regions and countries. Different regions may experience varying economic conditions, political stability, and regulatory environments. By diversifying globally, you can reduce the impact of any one country's economic or political events on your portfolio. This can help spread risk and potentially capture opportunities in different parts of the world. Individual security diversification, diversifying within each asset class by investing in a variety of individual securities further reduces risk. By holding a diversified portfolio of stocks or bonds. For example, you can minimize the impact of any single company's poor performance or default on your overall portfolio. It's important to note that even within a diversified portfolio, individual securities can still be subject to specific risks, so thorough research and analysis of individual investments is still necessary. Rebalancing, diversification requires regular monitoring and rebalancing of your portfolio. Over time, the performance of different investments can cause your asset allocation to deviate from your target allocation. Rebalancing involves periodically adjusting your holdings to bring them back in line with your desired asset allocation. This ensures that your portfolio remains diversified and aligned with your risk tolerance and investment objectives. It's important to remember that diversification does not guarantee against losses or ensure a profit. It is a risk management strategy that aims to reduce the impact of individual investments on your overall portfolio. However, diversification cannot eliminate the possibility of all investment risks. It's advisable to consult with a financial advisor who can provide guidance on constructing a well-diversified portfolio tailored to your specific financial goals, risk tolerance, and time horizon. Balancing the pursuit of capital gains with a diversified portfolio approach is important for managing risk while seeking investment growth. Here are some considerations for striking a balance between the two. Set clear investment goals. Define your investment goals and align them with your risk tolerance. Capital gains-focused investments generally carry higher risk and volatility. If your primary objective is capital appreciation, you may be willing to accept the higher risk associated with concentrated investments. However, if preserving capital and managing risk is a priority, a diversified portfolio approach may be more suitable. Determine risk appetite. Assess your risk appetite and capacity. Diversification helps reduce the impact of any single investment on your portfolio, but it may also moderate the potential for high capital gains. Evaluate how much risk you are comfortable taking and consider diversifying your investments across different asset classes, sectors, and regions accordingly. Asset allocation. Establish an appropriate asset allocation that aligns with your investment goals and risk tolerance. This involves determining the proportion of your portfolio allocated to different asset classes, such as stocks, bonds, cash equivalents, and alternative investments. A well-diversified portfolio can still include growth-oriented assets that have the potential for capital gains, but they should be balanced with more stable and defensive assets to manage risk. Diversify within asset classes. Even within asset classes, diversification is important. For example, within stocks, consider diversifying across different industries and company sizes, large cap, mid cap, small cap. This can help manage sector-specific risks and reduce the impact of any one company's performance on your overall portfolio. Regular portfolio review. Regularly review and rebalance your portfolio to maintain your desired asset allocation. This involves selling investments that have performed well and may have become a larger proportion of your portfolio, to lock in gains, and investing in areas that may be underrepresented. Rebalancing ensures that your portfolio remains aligned with your risk tolerance and investment objectives. Seek professional guidance. Consider consulting with a financial advisor who can help you strike the right balance between pursuing capital gains and maintaining a diversified portfolio. They can provide personalized advice based on your specific financial situation, risk tolerance, and investment goals. It's important to note that the pursuit of capital gains inherently involves taking on higher risk, and there is no guarantee of positive returns. Diversification helps manage risk but may moderate the potential for high capital gains. Finding the right balance between the two depends on your individual circumstances and investment preferences. A well-structured portfolio considers both capital appreciation potential and risk management through diversification. Assessing risk tolerance is a critical step in aligning investment strategies with your individual preferences and financial goals. Understanding your risk tolerance helps determine the appropriate level of risk you are comfortable taking on in your investments. Here are some key factors to consider when assessing risk tolerance and aligning investment strategies accordingly. Time horizon. Consider your investment time horizon, which is the length of time you expect to hold your investments before needing the funds. Longer time horizons generally allow for a greater tolerance for market fluctuations and higher risk investments. If you have a longer time horizon, you may be more inclined to take on higher risk investments with the potential for greater capital gains. Financial goals. Evaluate your financial goals and objectives. Determine the level of risk you are willing to accept based on the importance of achieving those goals. If your goals are more short-term and require a specific amount of money within a defined time frame, you may opt for more conservative investments to minimize the risk of capital loss. However, if your goals are more long-term and you have the flexibility to weather short-term market volatility, you may be comfortable taking on higher risk investments. Risk capacity. Consider your financial capacity to handle risk. Assess your overall financial situation, including income, expenses, debt levels, and emergency savings. Understanding how much financial cushion you have can help you determine how much risk you can afford to take on in your investment portfolio. It's important to ensure that you have an appropriate level of diversification and risk management strategies in place to protect your financial well-being. Emotional factors. Evaluate your emotional response to market volatility and potential losses. Some investors may be more comfortable with market fluctuations and can stay invested during downturns, while others may feel significant stress or anxiety. Understanding your emotional response to risk can help you determine the level of volatility you are willing to tolerate in your investments. Knowledge and experience. Consider your level of investment knowledge and experience. If you have a deep understanding of investment concepts and are comfortable navigating complex investment strategies, you may be more inclined to take on higher risk investments. However, if you are relatively new to investing or have limited knowledge, you may prefer to start with more conservative investment options and gradually increase your risk tolerance as you gain experience and knowledge. Seek professional guidance. It can be beneficial to work with a financial advisor who can help assess your risk tolerance and guide you in aligning your investment strategies accordingly. They can provide personalized advice and help construct a portfolio that balances risk and return based on your specific circumstances and goals. Remember, risk tolerance is personal and varies from individual to individual. It's essential to regularly reassess your risk tolerance as your financial situation and goals evolve over time. Reviewing your risk tolerance periodically and adjusting your investment strategies accordingly can help ensure that your investment approach remains in line with your comfort level and financial objectives.